Hello and welcome to this week's episode of The Capitalist Investor. As always, you have me, Diamond Hands D, and Tony the Tiger.
Yeah, baby.
And this week, standing in for Luke, we have Dave Abate back.
Great to be back, boys.
Yeah, no nickname yet, man.
No,
you gotta still earn your stripes.
It's been a while though since you've been on, so welcome back, Dave.
Thank you.
Yeah, we had our barbecue, and people were like, "When's Dave coming back?"
People were calling for it.
Mm-hmm.
Yeah, we
lot of people are asking.
gotta give people what they want.
All right, well, this week we'll kick off with the planning corner. And I think a pretty good topic to talk about, honestly, is kind of a summary of a lot of things that we've been saying through the weeks and, to lead up to the summer. But ways to stay ahead of risk. So, when we're putting together a financial plan, the last thing we want to do is just assume everything's going to be perfect forever, right? We want to make sure that, we can stress test that and we can get ahead of a lot of the risks that are out there. So I'd say probably one of the first risks we can talk about is, and we've been talking about it a lot, taxes going up, whether it's very shortly or sometime during retirement.
Yeah, it's definitely a risk. It's going to most likely happen if Biden wins. Definitely going up. He's already talking about what he's going to do, and we've had a show or two on that already. And then if Trump stays in, I'm sure he's a anti-raising taxes kind of guy. So we'll see what happens. But he does have a huge headwind ahead of him with all this debt that we have. So does it make sense to do Roth conversions? Question mark.
Yeah, and I think to set the table, if things happen without any interruption, right? The current tax rates are supposed to sunset at the end of 2025. And what that really means is, the marginal rates on average go up about 20%, 15 to 20%, 15 to 25%, depending on which bracket you're looking at. So as you guys are kind of laying out, does it make sense to make moves in advance of that known change? And it all comes down to like tax arbitrage, right? Does it make sense in your situation?
Yeah. A lot of conversations I've been having is like, hey, I'm 73 is the new RMD age, right? And as my account continues to grow and I'm forced to take out starting at somewhere around 3.65%, I don't need all that money. And I'm being forced to take it out and pay taxes on it. So you either got to pay it then or you pay it now. So if you can come to that realization, maybe paying it now makes a lot of sense just because of all the headwinds that are out there.
Exactly. And it's like that. If we look at the country and the deficits that we run, right, taxes probably aren't going down anytime soon.
No.
So, the guess is that they're going to accelerate, and to take some of that risk off the table, of that unknown of where they actually land, right? Take your medicine now and then know that you've paid the bill, and when it comes out on the back end in the future, it's going to come out tax-free to either you or your beneficiaries.
Yeah. Moving on to like inflation. So before I leave taxes, don't run out and do Roth conversions. Talk to your advisor first. Make sure it makes sense, because then it's a coordinated effort with your CPA to find out, does it make sense based on your income situation to do it? Because you might be working. Does it make sense to do it then? Should you wait till you retire? Are you retired and do you have room to do it? So again, just don't run out and do Roth conversions because we told you it might be a good idea, because I'm going to use the word might. Everyone's a little bit different. Inflation, increased retirement income. So as things go up around us, and we'll have a future show here in a couple days about retirees possibly going back to work because of increased inflation. But yeah, it's a real thing. We used to build plans at 3% when inflation was 1% and 2%. Now that inflation's 4%, do we still build them at 3%? Because it should normalize, building a plan for 4% and projecting that out 35 years might be a little bit aggressive. So, keeping it around 3% on a long-term basis makes a lot of sense. But with that being said, sometimes there are other things in your life that go up more than 3%. Energy, food, shelter, things like that. And some of those items are not necessarily calculated or put into the calculation for CPI, which they increase Social Security. As other things go up around for employers, does that leave room for them to, increase wages? So big headwind, but it's also a very big unknown. You don't know where inflation's going. You don't know what could spike it. You never know what could make it go up. Don't know what can make it go down. I can make huge assumptions like, hey, if inflation goes down, probably the economy's in a bad position. Inflation's going up. Well, there could be a lot of things, geopolitical issues, printing money from the government, government subsidies. There's cutting the Fed rate is a form of stimulus, which is then thus a form of inflation. So, you guys got any takes on those? Or?
Yeah, I would say, and something that we haven't already mentioned here in the last couple weeks, and I kind of mentioned it at the top of the show, the real reason to do a financial plan isn't just to do it one time. It's meant to be updated through time. And it's also meant to run multiple scenarios, right? That's really ultimately what we get to is as a Monte Carlo score. And all that score is just, 1,000 trials of a statistical calculation. So it's not giving us, just the right answer every time. It's giving us a range of outcome and trying to get your outcome in that positive range. So Tony mentioned if you take inflation from 3 to 4%, it's going to jack up your expenses really high towards the end of that plan, especially if you're, 55, 60 in that frame. So that's why you do multiple attempts or multiple runs of a scenario to show you, hey, well, if inflation does increase this way and it's elevated for 5 years and now we're going to average 4%, what happens to our plan? It's not meant to be the end-all be-all. It's meant to give you peace of mind knowing that if inflation does increase, then your plan would be okay. So understanding that it's not just, one answer that you're going to get. Planning is a process. So understanding the risks out there and running them through the plan is going to give you peace of mind to know that you're prepared for those roadblocks ahead.
And Derek, that's a great point. And our clients are already ahead of the game because what we see is most people when they start out, as prospects, the ones that have been ambitious enough to run that yellow pad financial plan, they're looking at that first year of expenses.
Yep.
And they're looking at that first year of income and they're extrapolating those numbers into the future, into perpetuity. And really that's the inflation is a silent killer in the whole process. And unless you model that out, exponentially, you really aren't getting a true picture of what retirement's going to look like. So going through that process, our clients have seen this before, but going through that process is really going to help you have confidence in transitioning from your working years to retirement.
Yeah, inflation, the invisible force inside your financial plan. Some people just forget to add it. And then the last thing, managing and staying ahead of risk is the market volatility, things like that. So we'll always say it, proper diversification is always a must. So, annual rebalancing as the market goes up or down, rebalancing your portfolio on an annual basis just equalizes your risk in both directions. Annual risk assessment, as some people get older, they get a little bit more scared of the market. So that's okay, but with lower risk, we need to understand that there's lower returns. I met with somebody yesterday, and I always say this, I've built hundreds and hundreds and hundreds of financial plans, and I can never look at somebody's balance sheet and say, yeah, you're good. I'm not a financial planning tool, like I've seen people, I'm like, man, this plan should be awesome. And it's not, or vice versa. I'm like, I don't even need to build a plan. This thing's going to bust up and break up and then it passes. I can get a good indication, but I'm not a planning software. Mm-hmm. And I met with somebody yesterday and they have a bunch of money in cash and CDs, scared of the market, don't want anything to do with it. Luckily for them, they know that, I know that they have a lot of guaranteed income sources, pensions, Social Security, a couple annuities, things like that, but they don't know what they spend, right? And at that point, it's like, well, we need that's the biggest number in the whole financial planning process. I need to know what you spend, because that's going to dictate if, you're going to run out of money or not. And, with that person I just mentioned, like they're like, well, I'm not susceptible to the market. It seems like an all-time high. I can't argue with you there. Yeah, that is a fact. The market's all-time high. But you have also a lot of analysts saying, hey, there's $5 to $6 trillion sitting on the sidelines in cash and CDs, just like you. And that's exactly what I said. And there's some analysts out there saying that the market's going to like over 6,000. You put a 6,000, we're talking another 20%. I've talked to people 2 or 3 years ago. I'm like, oh my God, I don't want anything to do with the market. And they missed out on 40%, 50%. And again, if you're gonna just do like the interest rate CDs, things like that, you need to understand that you have risk in that. There's interest rate risk. We are probably at a top on an interest rate hikes. Like they're not going to hike anymore, most likely. If they're going to do anything, they're going to cut. And now those 5% CDs are going to be 4% CDs and maybe 3% CDs. And now, do you think where's inflation going to go when that happens? So, again, that 5% CD against current inflation rates, your net, your after taxes and inflations and you're actually probably getting 1%. Yeah. After taxes and calculating inflation. So, it is a good headline number, but what are you really? How much are you really pushing forward on it?
Yeah, and the way that I kind of look at it is the goal. Derek hit on it earlier. Like our process, we're not trying to get a precise number. We don't know how the future is going to play out exactly. We're running those 1,000 trials to figure out what are possible outcomes, right? So the goal is to build an all-weather portfolio. So think about like an all-weather vehicle that can go on any terrain. And then when you're doing those annual checkups with your advisor, you may need to change your tires out, right? We're going to go from winter to summer tires now to help us get better traction. So that's the kind of the analogy, the way that I look at it. And the goal is not to be necessarily like, hey, we're extreme, we're all pedal to the metal. We want to make sure we're gonna make it to our destination regardless of the forecast.
Well said. I don't have anything else to add in there.
Yeah.
So if you guys have any questions, comments, concerns for us here at the show, please hit us up at info@swpconnect.com, and we'll talk to you next time.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.